Since the beginning of January, the markets have been going down around 11%. And it seems that it's not about to stop. As we see right now, the S&P futures are down 2% pre-market with Russia invading Ukraine. If we look at the chart for the S&P 500, the S&P index, well, you can see that it's quite ugly. This is January 3rd, the first day of the year for 2022. And you can see that since the beginning of the year, the market has been going down. We were at 4,800 and now we're at 4,200. And it doesn't even tell the whole story, because if we look at the S&P futures, if you don't know what futures are, I consider it a bit to be like a weather prediction. You know, when you look at the weather prediction on TV for the next day, well, that's basically what futures are for me. It's telling you what the market is doing right now. And it's usually, for me at least, a pretty good indicator of what to expect for the next day. And if we look at the S&P futures, you can see that the market is actually down to 4,100, which would basically put the losses of the year to date at 13% for the S&P 500. When we see that the market is down around 11%, 13%, whatever, how is my portfolio doing? When we look at my portfolio, you can see that on most of my positions, I'm actually down right now. You can see that I basically lose some money on each and every single position. The reason is because I sold puts. And when you sell puts, you are long. Hence why when the stock is going against you, you're going to lose money. Pretty logic, right? Except for one position on Bank of America, where you can see that I basically sold a call. I don't even remember for how long I've had this trade on, but I think around October, it's September if I'm not mistaken. Well, this is basically the worst trade I've had since 2021. And with this down move that we're having right now, well, I think I'm basically going to be able to close my trade for a profit overall. So you can see that even if a trade can take you, like, let's say, I don't know, 4, 5 months, 6 months to come back in your favor, you know, you can still roll your trades over and over, and hopefully you're going to make money in the end. In terms of what is my performance year to date, you can see that I lost $1,300, $1,400 year to date, which basically equals 5% of my portfolio. So I lost 5% since the beginning of 2022. So of course that's bad. Of course, trust me, I wish I was up 5% and not down 5%, but it's not that bad as much as you think. And here's the reason why. When we look at the markets right now, it lost 11% and I'm down 5%. So you see that, you know, of course I'm down, but it's not as bad as someone who would have invested in the S&P 500. And it's a really, really important thing to take into consideration when we compare performances. Because when you're trading options, there's a lot of things you can do in terms of rolling your trades, and I'm going to explain it just after, but there's a lot of things that you can do so you can make your situation a bit better. That's how I came up with this 5% down instead of being down 11% like the S&P 500. And the good thing is, when the market is going up, like when the S&P 500 is going up, I'm making more money than the S&P 500. But when I'm losing, I'm not losing as much as the S&P 500. So this is really the benefit of trading options, is that when I'm down, I'm not down as much. And when the market is up, well, I'm making more money than the S&P 500. And so far, to give you a bit of a benchmark, or at least what I've seen in 2021, and for those who have been watching my channel throughout 2021, you have seen the results throughout the year. I'm basically beating the market by around 7%. That was at least the results in 2021. I was beating the S&P 500 by 7%, and it seems so far that it's actually quite consistent. You see that I'm beating the index by around 6%. So, you know, I'm not unhappy with that result. Of course, I wish I was up, but you know, as long as I'm beating the index, to be honest, I don't really mind. One thing to mention that is extremely, extremely important, and this one I really want to emphasize it. This down move that we've had since 2022, since the beginning of 2022, is really the first down move that we've had since the COVID crash in February 2020. And it's really important because 2021 was really a year, as you can see, where we've had basically nothing happening in the markets. It's only been going up, and we really entered a very complacent state. And the fact of having that down move right now highlights one very important thing. It's the importance of trading small. Because here's the thing, if I wasn't trading small and I was placing all those trades and I was over leveraging myself, I would basically be down maybe 2 or 3 times, or who knows, 4 times what the market is losing right now. And to give you a benchmark, I usually allocate 2% of my buying power per position. And if I hadn't been doing this, that situation would be a lot worse right now. But because I really care about my portfolio allocation, I really care about trading small, you can really manage losses very easily. And that's actually a very good transition to talk how I'm going to manage losses. There is a very, very, very important concept when you're selling options. It's rolling options. And to make you understand the importance of why rolling options can actually be a very good defense strategy, let's take an example of someone who rolls options versus someone who buys, for example, the S&P 500. And let me show you. Let's imagine that this is the market going up since the beginning of 2021, and then all of a sudden it's going down. If you had bought the S&P 500 at the top, exactly at the top, like, you know, you're very unlucky, you're buying the S&P 500 index at the very top, or you're buying an index fund at the very top. If the market is going down, let's say by 10% that it is right now, you need the market to come back up to where it was, to around like by 10%, 12%, whatever, to actually be back at break even, because that line is your break-even point. Above, you're going to make money. Below that level, you're going to lose money. Pretty straightforward, right? That's how it works when you're buying stocks. And if it goes above your entry price, then you're making money. If it goes below, you're losing money. So far, so good. Well, the thing with options is that if the markets are going down, you won't need the market to come back as much as someone who would have bought the index fund, because you're rolling options. And let me show you. If we're just taking that away, and let's say that this green line that we have on the screen is your entry price. Let's imagine that that was your entry price and you have sold a put. So you long the market exactly as someone who would have bought the S&P 500, but you're selling a put instead. So if the market is going down, you can roll your option. And I'll show you later in details what exactly it means. But to show you the big picture, instead of having your entry price over there at the very top, now you can reduce your entry price so it's only over there. So the benefit of that is that you don't need the market to come back as much as what you would have needed to if you had just bought the index fund, like someone who would buy the index fund normally. You just need the market to come back, instead of, let's say, 12%, you only need the market to come back by, let's say, 9%. And after that 9%, you're going to start making money, compared to someone who would have bought the index fund, who needs the index to come back by 12% to come back at break even and start making money. So to sum up, if you're selling an option on a stock and that stock is going against you, you won't need the stock to come back as much in your favor as someone who would have bought shares of that stock, because you can roll your option and reduce your entry price. So instead of needing the stock to come back by, let's say, what came down, let's say 12%, you only need the stock to come back by, let's say, 9% or 8%. And you can do this each and every single month, so you can reduce your entry price, so you can make your money back quicker, and you can start making money a lot sooner than someone who would have bought shares. So that was for the big picture in terms of what rolling options mean, but how does it work in terms of reality? How do you actually roll an option? Let's take an example with one of my losing trades so you can see what I mean. Let's say that I want to roll a trade, for example, on American Airlines. If we focus on that line, you see that I sold a put. Actually, I sold two puts at the 17 strikes. I had previously collected a credit of 49 cents, meaning that overall I collected $1. And now I'm in a loss of $136 on that particular trade. What I'm going to do is that I'm going to close my trade. I'm going to take my loss and I'm going to sell puts in the later expiration. Well, to show you exactly what it is, in the March expiration, I'm going to buy back. You see it's green. It means that I'm buying back my trade that I previously sold. I had previously sold two puts at the 17 strike. I'm buying them back right now. So taking my loss. I'm just taking my loss. But I'm not stopping there. I'm going to sell new puts in the later expiration. So you see that I had sold puts in the March 18 expiration. I'm going to sell now puts in the April 14 expiration after having bought back my puts in the March 18 expiration. If we look in the April 14 expiration, you can see that now I'm selling two puts at the 17 strike in the April 14 expiration. But why am I doing this? Why would I do this? Well, the reason I'm doing this is that as I'm selling puts in a later expiration, and the consequence of rolling my option is going to reduce my entry price, I won't need American Airlines to come back as much as what it went down to start making money again. And that's the consequence of rolling options. When you roll your options, you're reducing your break-even point. And by reducing your break-even point, it means that you won't need the stock to come back as much as what it fell. So if we look at exactly at the chart to show you a real example, let's say that your entry price was, for example, $18 per share. Okay, if you had bought the stock and now the stock is at $16.64, you need the stock to come back at $18, and after that, above that level, you will start making money. But with options, as you're rolling them, instead of needing the stock to come back at, for example, $18, now you only need the stock to come back around $17 and for example 14 cents, and that will be your new break-even point. And that's why it's really cool with options, and I hope it makes sense what I'm saying. You're reducing your break-even point, so you don't need the stock to come back as much in your favor, and that's really cool because when you're in a loss, well, you know that you can basically improve a bit your situation, so you don't need the stock to come back as much in your favor. And that's basically what I'm going to do for each and every single loss that I have on all my positions. I'm going to buy back the trade and take my loss on those trades, but I'm going to sell new options in later expiration so I can reduce my break-even point, so I can reduce my entry level, so I can start making money faster than someone who would have bought the shares. And that's really the amazing thing with options. And you know, if you're scared with options, I mean, to be honest, there is more reasons to be scared when you buy the stock, because there is nothing you can do to reduce your what we call cost basis compared to options where you can try to make your situation a bit better, and you don't add any more risk, you don't add, you know, anything, you're just reducing your break-even point by just giving yourself more time to be right, which is pretty amazing. And if we take back on my example of American Airlines, if I decide to roll my trade to the next expiration, what's cool is that with Tastyworks, it's really made for options, so they really simplify the process. You can see that I clicked right and then I said roll expiration, and you can see that if I roll my trade to the 14th of April expiration, I'm going to roll my trade for 39 cents of credit. So now I'm improving my break-even point by 39 cents on the stock. And if you keep doing this every single month, then your situation is going to get better and better and better. And the moment the stock starts coming back in your favor, you will start making money a lot faster than someone who would have bought shares at the beginning. That's basically what rolling is. I really hope it makes sense. And I know it can seem complicated like at first when you hear about it like this in an example, but you do it once or twice and then it starts becoming really clear. So don't worry if you don't understand it completely yet. It's normal. It takes a bit of time to get it, but just do it once or twice, trade small with a trade, and once it goes in loss, roll your trade, and after once or twice you will see that it starts making complete sense and you will never want to buy shares again. And that's why I was saying that it's really important to compare apples to apples, and you cannot just, for example, if we look at my performance, yes, I'm down 5%, but when you compare, for example, against the S&P, because I'm able to reduce my cost basis by rolling options, then my situation is a lot better than someone that would have bought, for example, shares of the S&P 500. And you can see already the effect of rolling options is that at first I was down around 1800 when the S&P 500 was around that level. And now we are at that level and I'm only of course, quote unquote, down $1,300. And that's because I've rolled options, is that because I've collected credit and I was able to improve my situation over time. I hope it makes sense. I know it's not the easiest subject. I know it can be quite hard to just watch on a YouTube video, but trust me, it's really one of the most amazing things about options is that when you're wrong, by just extending the duration of your trade, by just giving it more time, you're making your situation so much better than someone who would have bought shares of the same stocks. That's really why I trade options mainly. And to show you in a bit more visual way what the break-even point is, this is basically my trade for American Airlines. So you see that we have the stock price, you can see here on the horizontal line, and you can see that I have this red zone and green zone. And you have this point at the very middle at $16.53, where basically if the stock goes below basically $16.55, I'm going to start losing money. And if it goes above that point, I'm going to start making money. Okay, so that's my situation right now as my trade is. Put that number in your mind. Now let's see what is my new break-even point when I roll my trade to the next expiration. So now you can see that I have my orders in. So I would basically buy back my two puts and I would roll my trade. You can see that we cannot really see it clearly because there's the order in the front, but you can see that at expiration, now my new break-even point is $16.13 compared to before where it was $16.55. So you see that by just giving more time for my trade, I'm now reducing my break-even from $16.55 to $16.13. So now it's, of course, it's not like a massive improvement, but if you keep doing this every single month, then you know your situation is only going to get better and better. And basically you just need to be patient and give more time for your trade, and you just roll your trade every single month, and trust me, it's going to get right at some point. I hope it was useful to see my portfolio and how I basically plan on improving my situation, and I really want to document that process so I can be transparent and I can show you guys what it's like to trade options and how you can roll your trades to make your situation better. Please make good and informed decisions. I'll see you in the next video, and in the meantime, I wish you all the best.